Hi everyone, it's Cherry Chan here. It's April 2025 and Canadians are racing to file their 2024 tax returns. Whether you're a real estate investor, small business owner, or employee, there are some tax deductions and credits that can save you thousands of dollars, but only if you know what to look for. Now, but before I go down into talking about all these deductions and credits that you don't want to miss, make sure you give us a thumbs up if you think that our video is helpful. Share that with your friends and families. Now, with that, let's dive right into the 9 deductions and credits that you don't want to miss before the April 30th deadline. Now, the first is home office expenses. Well, different rules apply for employee versus self-employed individual versus having a business inside the corporation. And today's focus is on employees and self-employed individuals. Now, specifically for employees, if you work from home in 2024, you need a signed T2200 form from your employer in order for you to deduct expenses. What you can deduct in terms of home office expenses depends entirely on what's authorized in the T2200, and it also depends on whether you're a salary employee or a commission employee. Now, the amount of expenses that you would be eligible to deduct can include anywhere from a portion of your rent, internet, a portion of your utilities as well. If your T2200 form, the employment expenses form being filled out by the employer, also specify that you incur cell phone expenses, parking, mileage, or other costs for the purpose of earning your employment income, you might also be eligible to deduct those expenses. Now, you must use the detailed method now to deduct your employment expenses, and the simplified flat rate was discontinued in 2022, unfortunately. Now, for those of you who are self-employed individuals, if you are self-employed, your home office expenses may include utilities, internet, maintenance. It could even include mortgage interest, property taxes, home insurance. These are all eligible for deduction if you're a self-employed individual using your home as your main office to earn self-employed income, so business income. Now, if you incur rent, you are also eligible to deduct rent if you don't own your own home. And if you live in a condo, then it's also important to have a time logbook in terms of how many hours a day you use that specific space to run your business. Let's say you work out of your kitchen and you use 8 hours a day, you work from there 8 hours a day, you can only claim 8 hours a day of a day in terms of expense. So let's say it's 1/3 and you only work there for 50 weeks, and so you prorate it from there, and that's the amount that you would be eligible to deduct in terms of rent. You have to proportionate it. Now, it's also important as a pro tip to keep a floor plan and calculate the business use portion of your home. CRA loves to see this during audits. Now, second deduction. For those of you who are parents, childcare expenses are a huge tax deductions that you can get. Now, if you pay for daycare, summer camps, nannies, or after-school programs that have the daycare portion, you would be able to deduct up to $8,000 per child under 7, only up to $5,000 per child age 7 and 16, $11,000 per child with disability. Now, you must keep the receipt from the childcare providers. If it is your nanny, you issue a T4, you must keep a copy of the T4 and also their social insurance number. And this childcare expenses is usually claimed by the lower income spouse. It's actually required to be claimed by the lower income spouse. Number 3, RRSP contribution. Now, you need to know, we all know RRSP contribution is one of the ways to defer your taxes into the future in the year that when you are not making as much money. You need to know what your limit is and the strategy of leveraging RRSP contribution. Now, specifically for 2024 taxation year, RRSP contributions made on or before March 1st, 2025 can be claimed for your 2024 tax return. So you can offset against your income and reduce your taxes that way. But let's clear up some confusion. Your actual contribution limit is calculated as a percentage, 18% of your 2023 earned income, up to about $31,560. Now, CRA confirms your RSP room because if you don't use those room, you would be eligible to carry forward your RSP contribution room to the future year. So the actual eligible amount that you would be able to contribute would be based on what's on your notice of assessment. So you need to go back to your prior year notice of assessment. If your 2024 income was low, you can choose not to deduct your RSP contribution. Even assuming that you have already made contribution, you don't have to deduct it. You can choose to carry the RSP contribution forward for use in a higher income year. The strategic RRSP deduction timing can maximize your refund when your marginal tax rate is higher. And on the flip side of it, if you're not making as much income in 2025, you may want to consider withdrawing money from your RSP to trigger some income and pay some small amount of taxes. So that's also a strategy that you should consider if you foresee yourself for not making as much money in 2025 or in future years, any future years. Now, number 4, capital losses and business losses or non-capital losses. Well, this started off from many Canadians, many of my clients as well, lost money in 2024. Now, either through the stock market, the real estate market, or private lending deals that are outside of the registered accounts. Now, let's break it down. So if you realize capital losses during the year, you can apply the capital. You need to first report the capital losses. You need to report the disposition of the underlying asset, whether it is real estate, whether it is stock, whether it is private lending. If you incur a loss, you need to report it on your tax return first. Once you report the loss, you can then use the loss to apply. You can apply the loss when you sell capital property at a gain. So you would be able to apply the loss to offset it against the capital gain that you earn. So you could be losing money on real estate, but you could be making money from your from the sale of your stock. So the two can offset against each other. Now, you may not have capital gain in the current year, but you still should be reporting your loss because capital losses can be carried back 3 years or carry forward indefinitely. And CRA tracks it for you. So you don't have to worry about it. They always track it for you. Now, you can also use the capital loss to reduce the taxes that you pay on past gains. So for 2024 losses realized, you can carry it backward for 3 years, meaning that you can carry it backward for 2021. If you sold something in 2021 and realize the capital gain, your 2024 losses that you realize can be carried backward to 2021 to offset against it. Obviously, that was an example. You can offset the capital loss against 2022, capital gains realized in 2022 or 2023. And yeah, so that's awesome. And of course, if you realize a loss in 2024, and if you did not have any capital gains in the prior 3 years or in 2024, you would like to carry forward the losses to future years, that's also available. Now, for some of you who did not incur capital loss, instead they incur business losses. Now, business loss is also called non-capital loss most of the time, and it applies if your activity was treated as a business. Now, as an example, real estate flipping, if you flip a house and lose money, if you do a lot of assignment deal and you lost money, or if you run a business and the business incur a loss. Those are business losses. And the losses may be fully deductible against salary, rental income, business income, or any other income that's being reported on your personal tax return. Similar to the capital losses, business losses can also be carried back. Any undeducted capital losses can also be carried back for 3 years, and it can also be carried forward for 20 years. So if you report the loss and you use the loss to offset against other sources of income, so employment income, any other sources of income, and if you still have excessive non-capital losses available, you would be eligible to carry back for 3 years, just like capital losses, but you can also carry it forward for 20 years. However, it's only 20 years, unlike capital losses that could be carried forward forever, indefinitely. Special note to those private lenders out there, if you loan money to earn interest and the borrower defaulted, you may be able to deduct the loss as bad debt as capital losses. For majority of us, it would be capital losses unless your main and only business is private lending, and it is really hard to argue with CRA on this one. So majority of the time, our clients are reporting it as capital losses. And it's important to report it, like I said, because capital losses can be offset against other capital gain on the sale of your properties, on the sale of your stock market, on the sale of other personal assets like cottages. Number 5, business professional expenses. If you're self-employed or earned commission income, here's what you would be eligible to deduct. The rule of thumb is that you would be eligible to deduct any reasonable expenses that you incur for the purpose of earning that particular stream of income. And some of them are fairly straightforward. It could be accounting, legal, and consulting fees. It could be internet, phone, and office supplies. It could be software subscription, advertising. It could even be your vehicle expenses if you drive around to see your clients. And with respect to vehicle expenses, of course, you need to keep a mileage log. And if you are also eligible to deduct 50% of the business meals and entertainment that you incur, unfortunately, golf expenses are not deductible, even if you strike any deals, all deals on the golf courses. But the golf games alone is not tax deductible. Meals at the golf course are deductible. Now, even if your business shows a loss, these expenses you may be able to reduce your overall taxable income or create a non-capital loss to carry it forward. So it's always important to report everything. Now, number 6, interest on investment loans. Now, interest is generally deductible when the borrowed funds are used to earn investment income or business income. Such as the case of borrowing against your home equity line of credit to buy a rental property because you're generating rental income, such as the case of rental property mortgages, that you borrow money to purchase that rental property. There's a mortgage attached to that rental property. The mortgage interest related to the loan is tax deductible because the loan is incurred for the purpose of earning rental income. Home equity line of credit and loans used to buy stock or investment in real estate, also tax deductible. Home equity line of credit interest is deductible if you use the borrowed funds to lend money to do private lending. If you borrow money for business operations, say I have a business, I borrow money to fund my business operation, the interest on the loans to fund your business operations would also be tax deductible, provided that the intent is to earn income on the property from the properties or various investment. Dividend income would also count. Now, funds must be traceable. Here's the big key here. You must provide evidence that there is a transaction tracing back to the borrowed funds. This means like bank records. This means like line of credit records. This means that it could be your lawyer office, a closing document. And also, if you mix investment borrowing with personal borrowing, CRA may deny the deduction. As a minimum, you would only be eligible to deduct the interest related to the investment borrowing portion. Now, number 7, professional membership dues. Any dues paid to annual dues paid to maintain your professional designation. For me, is CPA. For real estate agent out there, it could be RICO. For nurses, it could be the Nurse Association. They are all deductible if you pay them in 2024, and the dues are required for employment or self-employed businesses. Now, employees, these can only be claimed if not reimbursed by your employer. So you cannot double dip. You cannot get reimbursed by your employer and also get a tax deduction on your tax return. Now, for those of you who are self-employed, you would be eligible to deduct the membership fees as a regular business expense. And membership fees to gyms, golf clubs, or other social clubs, they are generally not deductible. Now, number 8, donations. Now, this year is a little bit special because the donations timing actually matters. You can claim charitable donation made in 2024, and also those made in the first 60 days of 2025, sort of similar to the RRSP contribution limit. thanks to the Canada Post strike. So the government actually extended the date that would allow us to make the donation. So if you donate over $200, you will get 29% tax credit instead of 15% federal tax credit. Or if you make money more than the roughly $240,000 highest tax bracket, you will be able to claim 33% tax credit on any donation that you make. Now, it's claimable by either spouse, but typically we would claim it in the lower income spouse if it can help avoid OAS clawbacks or benefit phase-outs. With charitable donation, we typically claim on one spouse, and you can claim both spouses' donation in one particular spouse tax return to maximize the tax credit that you would be eligible to claim. Now, if you have any unused donation, you would be eligible to carry it forward for up to 5 years. Number 9, multi-generational home renovation tax credit. If you renovated your home in 2024 to add a secondary unit for a senior or disabled relative, you may be eligible for a refundable credit, which is equivalent to at maximum 15% of the renovation expenses, and this is up to $50,000 in cost. So the maximum you would be eligible to claim is $7,500 of refund. I know $7,500 in the grand scheme of things to renovate your basement and put a legal secondary suite in is not a lot, but anything helps. And the unit must be a self-contained suite for qualifying family members, and it has to be available even if you owe no tax. And the last thing but not least, there are some other credits you might be missing and you should consider, and do not overlook these credits. The first one is the disability tax credit. Disability tax credit just under $10,000. 2024, you can claim the disability tax credit if you are disabled or if your dependent is disabled. So there are strict rules, and the disability tax credit has to be first claimed by the person. Well, let's not include that 9. The disability tax credit has a lot of strict rules in terms of who would be eligible to claim and offset against the taxable income. But the first thing first is that the person who is disabled need to have a Form T-2201 filed, and it has to be approved by CRA before you're eligible to claim the disability tax credit. And if you are not sure if someone is eligible to claim the disability tax credit, make sure you visit go to Google and search T-2201 form, and you would be able to see the detailed criteria. You would need the doctor's sign off on that form as well. And sometimes if you're not sure, and sometimes it may be worthwhile to fill out the form and have the doctor look at it. And if they sign off, we submit it to CRA, and then you can see if you're eligible to get the tax credit. Another tax credit that's available is called medical expense credit. Medical expense tax credit, you can claim any expenses over the lesser of 3% of your net income, or up to a maximum of $2,800. Roughly $2,800. Is actually less than $2,800. Check the actual number. But if you do accumulate all the medical receipts during the year, give it to your accountant or bookkeeper that does your tax return, and make sure that it's over 3% of your net income. Now, another one that was introduced a few years ago is called the Digital News Subscription Credit. It is 15% on up to $500 in eligible Canadian subscription. Another tax credit that is lesser known is the Volunteer Fighter or Search and Rescue Credit. In terms of Volunteer Fighter tax credit or Search and Rescue credit, the maximum you would be able to claim is about $6,000. You can claim either one, but you can't claim both at the same time. Final thoughts as of April 2025. Make sure you don't just file. You need to optimize your tax return. Here's your final checklist. RRSP contribution, did you deduct now or save it for later? You can choose to deduct it in current year if your income is high. You can also defer a portion of your contribution to future year if you think that your tax rate is going to be higher. Make sure you have that conversation with your accountant. Home office expense, make sure that you have the T-2200 signed by your employer, and the expenses has to match with what expenses deducted on your tax return has to match what's been approved on T2200. If you lost money in 2024, make sure that you classify the losses correctly, whether it's capital or business. Make sure you also report your losses to maximize your tax benefit. If you made donation early in 2025, there is an opportunity to claim it in 2024. And make sure you review all the tax credit, especially the refundable ones. The CRA won't chase you down for unclaimed credit, but we make sure that you don't miss a thing. Until next time, happy Canadian real estate investing!